In this video, I'm going to talk about how you could benefit from the low interest rate environment and taxes due to the changes made in the IRS code this year. And there's some benefits to it, and I'm going to be explaining to that in this podcast. Hi, my name is Pascal Mangat, and you're watching the Financial Ownership Podcast. So, the IRS made new changes to the tax code 7702 for life insurance, which allows you basically now to put in more money into your life insurance contract with less of a cost. We are in an economy currently where everything is almost at all-time high. If you look at the real estate market, if you look at the crypto market, if you look at the stock market, all these things are trading at much higher prices due to things like the lowering of interest rates and the increasing in inflation. And it's only a matter of time, who knows when, but eventually the market has to correct because things can't keep going on an upward slope forever, right? So now more than ever, it's going to be more important to find ways to lock in rates of return while still getting that benefit of the increasing markets. What allows you to do this, to take advantage of the cash benefits or the living benefits of your life insurance policy at a less amount, is what the IRS now lets you do is lets you put in more money into your contract with a lower death benefit. So basically that means your cost of insurance is going to be less, and now you're going to have more money in the cash value of your life insurance policy, which means you're going to have more money growing at a tax preferred way and hedging against inflation and hedging against market risk. For example, let's say you're 25 years old. So last year when you're 25 years old and you had $200,000 worth of death benefit in your life insurance policy, you would only be able to put $3,000 every single year in your policy. Now, what you can do, that same 25 years old person or 26 or somewhere around that range, they would be able to get that death benefit of about $200,000 and put in $6,000 into their life insurance policy. This is actually something that I did for someone this year. She was able to take advantage of the new legislation that has recently been passed. So what I did is I helped her structure a max funded universal life contract where she puts in $6,000 every single year or $500 every single month, taking advantage of all the tax benefits and cash accumulation benefits in a life insurance policy while avoiding market risk. And what this means is you get to reduce the cost of your insurance significantly. So you get to take advantage of all the benefits that a life insurance policy has to offer while paying a lot less in fees that you would have paid last year. The key is to contribute as close to the guideline annual premium as possible. When you're doing that, you're lowering the cost of your insurance significantly. And even if you could do something, say, there's some people that when they have a lot of money, they'll even 10 pay or 5 pay those policies, completely pay them in that period of time, and they'll have more money in that policy in earlier periods of time to really take advantage of the cash value component and grow their money in a tax preferred way while hedging against market risk and inflation. And obviously, the sooner you can put money in the contract, you're going to get the most cash benefits off of that. But most people can't do that. So even doing it where you're funding it up to the annual guideline premium, you're still going to get some relatively solid results that you're not going to be able to get from a lot of other funds through doing this over time, while still keeping some liquidity where you could take advantage of things like down markets. And some companies even give some things like uncapped indexes where you could get the entire performance of the S&P market minus the spread, but that's a conversation for another video. But let me show you an example of what it looks like. Let's say someone put money in this contract for 25 years. So if you look at the screen, this is what a max funded contract will look like, considering that you could contribute up to the annual guideline premium. So this is what I did for a client recently. So what she did is she's contributing $500 a month into this policy. The face amount or the death benefit is $220,000, and she's basically contributing the max amount close to that $6,000 range that you see over here in guideline annual premium, which is the end of the year amount that you could contribute, considering that you're going to be putting in this policy for, say, 20-30 years. This is the correct way to do it, considering that your goal is long-term growth and liquidity for your money, which is what the client wanted. So if you see here, look at the right side. So what I did is I put it into this account where it's mirroring an S&P 500 index. It's linked to it. I'm going to explain more about that later on in the video. But really what this is showing is basically a 5.96% assumed interest rate, which is not very high. It's a pretty decent interest rate to see what you could potentially expect in the future for something structured like this. So you see over here, the beginning year, since she's just putting up to the guideline annual premium and she's not 10 paying or 5 paying it, there's somewhat limited liquidity within the first few years, but within the first 5, if you look at year 6, you basically have access to all of your money. But really, the way this is really going to be good for her is in the long term. So if she wants to maximize on things like the down markets and things of that sort, this particular strategy allows you to, or this particular company allows you to participate in an uncapped strategy where you get all the gains of the S&P market minus the spread. So if she wants to maximize on the fact that the market goes down at some point, let's say in the next 5 years the market goes down, she could participate in most of the gains of the market when it recovers by using an uncapped strategy. And I will go more into that in another video, but this is just based on if she just kept it with this assumed interest rate. Let's say the average assumed interest rate of this policy throughout the life of it is 5.96%. It's assumed, it's not guaranteed, but it's not a crazy interest rate. It's pretty normal for something like this to perform somewhere around 5 to 6%. I have this stopping basically when she reaches age 55, and she would have contributed up to $180,000 up to this point. So with that, considering that she contributed $180,000, let's say that she decided to take out distributions at 60 years old. With these distributions she's taking at 60, she's taking about $38,000 for basically up until she's 85. And if you look at this right side over here, by age 60 she'll have about $514,000 in cash value. And if you look over here where it says net annual outlay, all the way up until 85, considering that she takes $38,000 without taking tax risks and without taking market risks, by 85 she would have took about $810,000, considering she just funded it the way it was, the way I structured it for her, all the way up until age 55, and then didn't put a dime more and then took withdrawals from it. And you can see there's still cash value and death benefit left even after taking that amount of money in. So all of this is done without taking tax risks or market risks.
The reason why the IRS passed this new 7702 update is because of the lowering of interest rates. So before, insurance companies used to guarantee something looking like 3 to 4%. But now, because of the lowering of interest rate environment, insurance companies can't do that anymore. So now what they have to do is lower the cost that people are putting in money in these policies for, but give them less of a guarantee. So it affects things like whole life insurance because they're not going to be able to get as much of a guaranteed interest rate people from now on that buy those contracts. But at the same time, if you're willing to take a slightly more risk by using an index universal life policy, this new change in the tax code is going to be very beneficial to you because you're going to be able to put much more or twice as much more into your index universal life policy at basically half the cost. For those of you who don't know how a universal life contract works or index universal life contract works, basically you'll get a cap of say 10% and a floor of 0. So if the market goes up 20%, you're guaranteed 10% of your money. But the market goes down 20%, you're guaranteed a 0% floor, so you won't lose money due to market volatility. And you get the performance of the S&P from an annual point-to-point basis. So basically from January 1st to the end of the year, you'll get the performance of whatever the S&P did at that time period. So out of all the permanent life insurance contracts, if you look at whole life, index universal life, and variable universal life, I think this is going to be the most beneficial for structuring a properly structured index universal life policy. Because if you look at whole life, now they're going to be giving less of a fixed rate of return. So the return, even though the cost of your insurance is going to be less, they're going to be lowering your guaranteed rate, and dividends have been going down and down every single year. So you're not going to be able to grow your money at a decent rate using whole life insurance. But index universal life insurance, you're going to be able to grow your money a lot faster because you get to tie to things like the S&P market. So you get the upside without the downside, and it gives you the ability to have more liquidity because now, since there's less cost of insurance, you can be able to access more of your money and take advantage of things like down markets. And the reason why I'm not a big fan of things like variable universal life is because of the lack of guarantees it has and the high fees. For those of you that don't know how variable universal life works, it is some of it goes into cost of insurance, like every single insurance policy, and another part of it goes into a cash value or a separate account. So this separate account goes into mutual funds, and generally speaking, the reason why I'm not a fan of variable universal life is the same reason I'm not a fan of actively managed mutual funds. Because mutual funds that are actively managed, they charge something like 1.5%, 2%, or even more sometimes to put your money into these mutual funds. But at the same time, if you're looking to get a non-guaranteed fund, you're better off investing in a passively managed index fund where there's basically a zero expense ratio, putting your money into these index funds, and your money can grow over time. You can use things like a Roth IRA for tax benefits, or you could just buy and hold in a regular brokerage account where you get long-term capital gains later on, and you'll be better off than getting charged high fees in an account with no guarantees like a variable universal life or an actively managed mutual fund. So I don't think having a life insurance contract should replace your investing. You should still have investments that you put your money in, like cryptocurrencies, real estate market, and the stock market. But what a properly structured life insurance policy that hedges against market risk can do for you is it gives you the ability to take advantage of things like down markets, and it gives you some sort of safety net that your money isn't going to go down a certain amount. So you always have some sort of liquidity or access to your money that is protected against market risk. And if all your money is in the stock market, say in a variable universal life contract, that means that you're not going to be able to take advantage of the same things that you would be able to with either a whole life or a universal life or index universal life contract. Well, at the end of the day, if you're looking to get total market exposure, investing in index funds is going to be the best way to do that. Either using a Roth account or using a regular brokerage account, I think makes the most sense, because these funds have a near zero expense ratio. But overall, I think this new legislation is the most beneficial for a properly structured index universal life contract. So if you really want to take advantage of that, you really should talk to someone that knows how to structure these the proper way, so you can take advantage of things like down markets and hedge against market risk and taxes. And this is going to be more important than ever with the changing environment that we have with lowering interest rates and taxes potentially getting higher in the future. If you found some value in this video, go ahead, like, comment, subscribe, and always I leave a link in the link in the description below. I have a link to my website. Feel free to contact me there. Thank you.